Hello everybody. At this time we are talking about a repurchase agreement or repo. A repurchase agreement is a financial transaction in which securities are sold with an agreement to repurchase them at a slightly higher price in the near future. The difference between the initial sale price and the repurchase price determines the interest rate, known as the repo rate, effectively making it a short-term loan. This investment is among the safer short-term investment because it has collateral support in the form of securities. As a financial instrument, a repo is an interest-bearing short-term loan secured by the security. The buyer acts as a short-term lender, while the seller acts as a short-term borrower. Collateral used in repurchase agreements typically consists of high-quality, liquid securities that ensure the lender is protected in case of default, such as notes and bills, asset-backed securities, corporate bonds, agency bonds, and others. And then, how does a repurchase agreement work? In a repo transaction, one party sells securities to another party and agrees to repurchase them at a specified date and price. The difference between the initial sale price and the repurchase price reflects the interest earned by the lender. Repos are usually short-term, ranging from overnight to a few weeks. Repo agreements can have fixed or open terms, with fixed-term agreements specifying an exact repurchase date and open agreements allowing either party to terminate the agreement with notice. In the context of repo versus reverse repo, a repo transaction is when a party borrows money and provides securities as collateral. A revenue repo is when a party lends money and receives securities as collateral. And then we move to types of repurchase agreements. The first type, term repos. This comprises longer terms repos, which could be for several days up to several weeks in comparison with the overnight repos. There are for longer funding needs. And then second, open repos. Open repos are those that do not have any due date of maturity, and those can be ended at any time by any of the two counterparties. Such a kind of agreement helps those institutions that need cash from time to time change. Third, repurchase agreement reverse. Just the reverse of the above procedures. Here, the buyer of the securities will agree to sell them after some time to the original seller again. Typically, it is used by the central banks to control the liquidity of the financial system. And then we move to benefits of repurchase agreements. Repurchase agreements offer several benefits for traders. Firstly, they provide a source of short-term funding, allowing traders to leverage their capital and take advantage of trading opportunities. Because the loans are secured by performance securities, they typically have lower interest rate than unsecured loans. Secondly, repos provide a way to manage risk. By using the securities as collateral, traders can protect themselves against potential losses. If the borrower defaults on the loan, the lender can sell the securities to recover their funds. This makes repos a relatively safe form of lending, particularly when the securities involved are low-risk government bonds. And then we move to risk associated with repurchase agreements. Repurchase agreements involve risks that both borrowers and lenders should be aware of. These risks can broadly be classified into credit risk, liquidity risk, market risk, and legal risk. The first, if the borrower defaults on the repurchase agreement, the lender may incur significant losses, and the collateral may not be sufficient to cover the losses. Second, the lender may also face liquidity risk if it cannot sell the collateral quickly in the event of default. And third, additionally, market risk can arise if the value of the collateral falls sharply, leading to losses for the lender. It is important to note that this risk can also impact the borrower. If the borrower defaults, they may face a deterioration in their credit rating, making it more difficult and expensive to borrow in the future. And then we move to purpose of a repurchase agreement. Repurchase agreements are considered relatively safe investment because the security functions as collateral. However, the safety of a repurchase agreement also depends on the creditworthiness and reliability of the parties involved. Repurchase agreements function like a short-term interest-bearing loan that has collateral backing. This type of short-term lending allows both parties to meet their goals of secured funding as well as liquidity. While repurchase agreements are similar to collateral-backed loans, there are actual purchases. However, due to their short-term and temporary ownership, they are treated as short-term loans for tax and accounting purposes. Repurchases contribute to facilitating cash and security flow in a financial system. They create opportunities for low-risk investment of cash and management of liquidity and collateral by financial or non-financial firms. And then we move to the role of repurchase agreements in financial markets. The significance of repos in ensuring liquidity for market participants is vital. Repo markets facilitate cash flow and securities around the financial system, often providing liquidity to other markets. Repos are used by banks, brokers, dealers, and other institutional investors to provide efficient short-term funding, stabilize and create a more resilient money market, and provide a secure and flexible home for short-term investments. This in turn can facilitate short investors, support corporate bond investors, and ensure liquidity in secondary market debt. I think that is enough. Thanks for watching.